everyone, and thank you for attending this webinar on quantitative strategies. Before we start the webinar, I want you to pay attention and read the required disclaimers. Thank you. The title of this webinar is Advantages of Quantitative Strategies, a professional approach to trading the current financial markets. In this webinar, I will show you that systematic trading can take advantage of the current market volatility and can protect and diversify your portfolio. We'll go through my background, strategy building process, quant system, 6 of 7 systems, so day Dow, Crude Light, Gold, Nasdaq Day, and Swing Crude. The only one that will not be illustrated is the natural gas. And we'll break down some trade examples, and we'll finish the webinar with the 6 big advantages of trading quant methods. So get to know the program developer. That's me, Luca Facchini. I've been recognized by my professional peers in the US and overseas for challenging common assumptions, developing innovative trading systems, method and trading buying signals in a variety of markets and financial instruments. I work as a commodity trading advisor, futures and option broker, system developer, prop trader, and market analyst in my early career. Due to my professional background, I have expertise in brokerage management, risk control, complex order placement, options and future spreads, trading advisor, and money management. I'm a published author and speaker on topics of stock, futures, options, forex, and commodities. For example, in the past I wrote frequently for a monthly Bloomberg investment magazine in Italy, and I held live trading seminars for CQG in Milan and other important financial organizations sponsored by banks and brokers. I love to understand the detailed mechanics of any financial products and the markets in which they're traded, in order to determine the relevant risk and reward factors and the best way to model them. I'm taking advantage of my professional experience as a broker, trader, and analyst to develop my trading programs. With over 20 years of experience in the financial markets, I learned from my mistake, my clients' common failures, and I've analyzed and studied the material of many proclaimed trading gurus. In my career, I created and tested and analyzed hundreds of systems and trading methods, ranging from market profile to spread trading, complex option strategies, and the conclusion is always the same: there is no holy grail in trading or investing. Because of my vast knowledge of the trading and financial industry, again, I was a broker for 15 years and as well as CTA, so I saw the retail side of the business and the professional side of the business. I know the reality of trading, what is really going on behind the scene of a broker house or a prop firm, and how difficult it is to produce positive results on a consistent basis, especially for the new traders. I consider myself a perfectionist to the core, and I strive to create robust systems that are 100% tested before going live and release them to the public. This is me in my office, and I will try to explain now my building process for my strategies. All the systems are programmed following a strict protocol to test for robustness and profitability. I develop a system based on goals, objectives, and ideas about a specific market and or a time frame. And then I see if these observations and concepts can become a rule-based trading system. Markets are always changing, and a good strategy must adapt to the latest market conditions. Or sometimes it must be re-optimized to reflect the new trading environment. Once I program the ideas or the objectives into a set of rules, it can be programmed in TradeStation, but also work with NinjaTrader or Sierra charts or other platforms or other languages. I move forward with the backtesting process. I backtest usually at least 5 years of data for day trading systems, 5 to 10 years for swing systems, and at least 10 to 20 years for position systems. Again, the markets are always changing, so whatever happened in the past really is not a guarantee of futures result, and you want to be on top of the latest market conditions. So first I test and develop a system on a limited set of data that is called in sample Then if the results are acceptable, and so for example I could test like 2-3 years of data going back 5 or 10 years ago, then I run the system on a second set of data that is unused, unseen, and this set of data is called out of sample. And I do this in order to see if the results are still in line with the past performance of the first test. If that is the case, I will stress test the system by using Monte Carlo simulation, walk forward analysis, and other statistical stress testing techniques. Sometimes, for example, I even use another set of data, like an extra out of sample, or I switch data sets. For example, I use for testing the latest test data, and I go back in time and see what was the result. When I see that the results are still positive, going back doing these different time frames and data sets, I will start the incubation phase. Basically, I will follow a strategy in real time. For example, it could be just a few weeks for day trading to a few months, depending on the strategy and the market, and then make some changes or optimization if necessary before going live. Or if I see problems and the system is underperforming for whatever reason, the market are changed, and then I would just discard the systems and move on with new one. So learning more about the quantitative systems, ideally we want a systematic strategy that is designed to diversify a trading portfolio by using non-correlated markets and or different time frames, and also trading logics. So for example, trading following, and so position trading, then a counter trend strategy, then a day trading strategy, then a swing trading, position trading, etc. Then you also want to have different markets that are possibly not correlated, so crude oil, Dow Jones, Nasdaq, gold, natural gas, S&P 500, etc. The strategy should be implemented only on the most liquid financial markets in order to keep the slippage at the minimum. The objective slippage is like, you don't want to have too much spread when you buy or selling a product, a system. The objective of the strategy is to cover in a systematic and mechanical way all the aspects of the trading activity. So when to enter in a position, when to exit, either a loss or a profit, the money management and the risk control are all inside the system, the quantitative system, and it's been backtested in many years and followed in real time. So we hope that the same parameters and rules will also perform in the future, at least for a while. So what we're trying to do here with trading quant strategies, a quantitative strategy is designed to take advantage of modern technology, mathematics, and statistical analysis. A computer program would generate all the trading activity without human intervention. So the systems are running on a server, on a broker house, and so there is nobody really buying or selling based on the moon phase or whatever. Currently, much of the trading activity in all the major exchanges is generated by automated strategies, also called algorithmic trading. Probably close to 80% of the activity on the major stock exchanges worldwide are now algorithmic in nature. Quantitative trading can be applied to many different trading styles. However, the main advantage of quantitative trading is the fact that the trader can rely on past performance, even if just theoretical, and statistical reports, compared to the discretionary trader that has usually a very limited sample of trades for his or her trading system or method. It's true that emotional trading is often the downfall of many traders. Sometimes even systematic traders are able to overrule their own rules and sabotage their own systems. But the single greatest advantage of algorithmic trading is the removal of emotion from the trading process. If you get emotional during trading or investing, quantitative trading is probably for you, because the decision of when to enter or when to exit is done by the program and executed by the computer and not by humans. The weakest link of this equation is for sure the human mind. In my experience, the number one reason why traders lose money is the lack of discipline in respecting the stop loss. A small loss becomes a huge one, and when to take profits. Taking profits too early is also a common mistake for beginners. So let's see some quant strategies, trading samples that we have taken in the last few months. We'll start with the Quant DAO day system. The Quant DAO is a technical rule-based system that trades intraday. The system can go long or short, the Dow Jones futures contract. The logic behind the system is based primarily on pattern recognition. For example, the relationship between day open and close, or the cross above or below the ideally low or high. The entries are usually at the market, and the exits are either based on stop loss, a target, or by the end of the day trading regular session, in order to be just a day trading system. The strategy tries to capture the underlying bullish or bearish bias of the stock market, and it will adapt the stop loss and the targets to the current market conditions. So bigger target, bigger stop loss in high volatility like we saw in the last few months, and vice versa in 2019 or 18 where there was no volatility, stop loss and targets are much smaller. We need definitely volatility in order to capture profits in the market. We can see an example here of back in March, and we see that we started with a loss of about $2,000, then we had a great short for about $5,000, and then the day after we captured a long side for another about $2,925. These were the Dow trades back in March 2020 during the crazy time of huge volatility, and the system performed very well during the time. This is the equity graph of the day Dow. Like again, 2018 and 19, not a big volatility, so the profits are not great. But then as soon as the volatility started to increase in 2020, everything started to work out very well for the system. And these updates are to March for the first quarter. For the second quarter, we'll update the equity graph soon, but the performance are in line with the first quarter. Second system we're going to analyze is a Quant Crude day system. Again, the logic is behind the system is based on pattern recognition. For example, again, the relationship between the day open and the previous close, or cross above the intraday low or high of the previous day, etc. The strategy looks to enter in position with a buy or sell stop. The strategy exits the open position by the end of the session, or is stopped out with certain conditions are met since the entry point. The exits for a long and short position adapt to the current market condition, and they are usually exit at the market if it's in loss, or at the end of the session with a win or a loss. The strategy offers diversification with a commodity, that in this case is a crude light, that is not usually correlated to the stock market. The strategy tries to capture the overnight market activity of the crude light, and it can enter at any time during the most active hours of the trading session. We see some examples here during the famous crash of April. We see that we had like a small loss, 640 to go long, and then is when the market really crashed. And we see that it was able to capture, first trade was $890, then $2,200, and then a huge, the day of the famous day the market went negative, $8,500 profit, then a loss, and then a couple of wins and another loss. Again, the market, more volatility there is in the market, and easy it is day trading system to capture some profits. This is equity graph of the crude light. You can see it goes back 5 years, and it's been pretty consistent. Then lack of volatility 18-19, and then the spike in volatility and also a spike in profits for the first quarter of 2020. The second system we're going to check, the next system is a Quant Gold day system. Gold is also been very volatile in the last few months due to the market condition. The majority of my system, again, is the relationship between day high and low, and the strategy looks to enter in a position with a buy or sell stop at the market. The strategy exit the open position by the end of the session, or stopped out when certain conditions are met from the entry point. The exit for long and short position adapt to the current market conditions based on volatility, and they usually exit at the market if in loss or at the end of the session with a win or a loss. To complement this system, we look to pair. I like to see this with the quantitative mini Dow or Nasdaq programs. Usually they are uncorrelated or inversely correlated. Not always, but the majority of the time when one goes up, the other one goes down. And when there is volatility, there is volatility for both markets. So both systems together can capture the bearish and bullish trend in markets on commodities and stocks. So the commodity in this case will be the gold, and then you can pair this with one of the Nasdaq or the mini Dow system, so one of the index systems. The strategy offers, like we say, diversification with a commodity that is not correlated to the stock market. The strategy tries to capture the overnight market activity of the gold, and it can enter at any time during the most active hours of the trading session. This system, we can see some examples here. Back in April, we have a loss, then a win for I can't see very well, 460, and then a big win, a big long for $2,100. The next slide is the equity graph of the day gold. Again, pretty consistent, kind of flat during time where there is a little volatility, and then again when the volatility starts to pick up, also the profits start to pick up. One thing about the going back to the gold is that it is actually a system that is formed by 3 other systems, so it's a very complicated strategy, but the results are being so far good. So is a typical system where there are other strategies in one strategy. So the next one is the Quant Nasdaq swing system. The Quant swing Nasdaq strategy is a technical rule-based, of course, system that takes long and short position on the mini Nasdaq 100 futures contract. The system is active during a 24 hours period, meaning actually it's more 23, but it's basically say that it's always trading. The system can go long or short, also after the regular trading session. And by trading a regular trading session, I mean when Wall Street is open, the stock market is open, that is considered a regular trading session, but this system will also take positions when the market is closed, in overnight, in aftermarket, because the markets are globally interconnected, and many trading opportunities are after or before Wall Street the usual business hours. Okay, so movement, some news in China or Japan or Europe can move the market a lot during the night. It happened a lot lately, and so this system tries to capture these big moves that happen overnight. The logic is very similar to the other system. It's based on relationship between high, low, close of the day before, plus true range. The strategy looks to enter in a position with a buy or sell stop and a breakout usually, and then also can also enter on a fade reversal correction area. The strategy tries to capture the underlying bullish bias of the Nasdaq index, but it can also go short, like we did in the last few months, and it will trade a maximum twice a day and on average about 20 times a month. To complement the system, we look to pair with a commodity system, for example, the Crude day or the day gold or the Quant natural gas system. Or for a stock market portfolio, you can complement this with the day Dow. Dow and Nasdaq usually they're not super correlated. We can see some trades here on the NQ swing back in January-February. We had a long trade back in February. Sorry, at the end of January for $2,000, then another $2,700. Then we had 3 losses in a row for about $1,300, and then again capture a couple of long position at the beginning of February. They were very good trades, about $2,800 profits. And when the market crashed, I don't have any examples here, but the system did very well during the downturn that followed in March. Then you can see the swing Nasdaq has been a very consistent equity graph since 2015-16. because it's able to capture the volatility of the Nasdaq. The Nasdaq is for sure the most volatile of all the indexes, and the fact that it can work overnight helps. And there are actually two systems working with different logics at the same time. So it is definitely a powerful system. Next will be the Nasdaq day system. So the day Nasdaq is also a good system because there is volatility and range in the Nasdaq. The logic is simple but powerful. Again, it's a pattern recognition and with true range and stochastic to identify overbought, oversold areas. The entries are again with the buy and sell stop, usually on a breakout. And the exits are at the market with a profit or a loss. The strategy is try to capture whatever is the bullish or bearish buys at the moment of the tech stock market, and so it will also go short in a moment of market downturns like we saw with the coronavirus problems back in February, March, and April. The system will go flat by the end of the regular trading session and start to look for new trading opportunities before the stock market reopens. Here we see some examples of trading back in March, and you can see there's a small loss, and then it was a gray short where the market was going down, and it was like a gigantic win for like about $9,000 or something like that. The equity graph of the day Nasdaq, again, has been pretty much consistent in the last few years, then kind of flat. Last year there was not a lot of volatility, a small loss toward the end of the year, and then the spike in volatility at the end of 2020, first quarter 2020, due to the coronavirus crisis. The Quant Crude swing system is similar to the Nasdaq. It will try to capture the overnight moves of the crude light, so not only day trading, but also what happen overnight and overseas on the crude light markets. Offer diversification because it's a commodity with a market that is usually not super correlated to the stock market, even though lately they go hand in hand. But this is a commodity; it's very liquid, and the strategy uses different indicators, like, for example, rate of change, adaptive moving average, ATR, zero lag trend, and other other indicators, plus pattern recognition. And I like to see this system going with a mini DAO or one of the Quant Nasdaq systems. And the strategy looks to enter in a position when with a buy or a sell stop, either on a breakout or after a correction. The strategy exits the open position by trailing the profit based on ATR, or stop out when certain conditions are met since the entry point. The exit for long and short position adapt to the current market conditions, and so the position are carrying overnight. So this was you have to think about the fact that with any kind of swing system that carry the position overnight, the margins are higher. And so, for example, in the last few months, unless you have a big count, this could be a little bit of a problem because many broker houses increase 200-300% the overnight margins. But usually that's not the case. I mean, we saw something never seen before with the crude light going negative back in March. So I'm sure that the situation now is going slowly back to normal. It will go back to normal. So we'll try to, with this system, try to get opportunities that sometimes are not available on stocks. Crude and the energies in general are the most active and volatile of all the futures market for the last few years. And so when the stock market was not really doing anything, the crudes and the crude strategy were performing well. We see here an example of the swing trades they were carrying overnight during the downturn of the crude light when it was crashing down, and we see that we have a win, a very good win then we had $700, then $450, then $760, then $730, etc., and going with the trend and basically taking only the short side of the market. The next one is the equity graph of the swing crude light. It's been kind of flat in 2017-18, and then pick up a little bit the short side crash of the market at the end of 2018, and it's been performing very well for the last couple of years. Now, I don't have the slide for the natural gas and the performance here. You can call us out if you're interested in see what the natural gas did, but it's been a very consistent market too. It's a volatile market and usually performs well during anytime. With day trading is one of the best markets to trade. So I like to tell you the 6 big advantages of quantitative strategies, why I think this is a superior way to trade or invest. First of all, number one, the money management and risk control. The objective is to cover in a systematic way all the different possible scenarios that could unfold during the trading session. The stop loss and risk control is automatic, is in the code of the system. And the trader or the investor doesn't have to worry about not respecting the stop loss. Usually that leads to disaster for the discretionary trader. I saw this many times when people don't respect their stop. A stop loss of only a few $100 became a few thousand, or they blow up the entire account. And that happens even at the professional level, by the way. But again, if there is one holy grail, if there is holy grail in trading and investing, is for sure the control of risk and money management. We cannot control really how much money we're going to make, but at least we can control how much money we can lose, and we can control the risk by placing on stop losses. There is no guarantee on anything, of course, stop losses or profits, but this is the only part that we can really control, or at least try to control, to be alive another day to trade. There is no emotional trading. The systems are always looking to find the best trading opportunities 24 hours a day, and once in a trade, they follow the rules that we establish and will exit without hesitation with a stop loss or with a profit. The same thing cannot be said with a discretionary trader, because based on whatever is your mental health in the moment, or if you slept the night before, or if you are sharp, you could exit too early, too late, not respecting the stop. So human traders are very emotional. At the day trading level, or for investing even in the long run, people get in love with stocks, and they don't give up even when the stock is completely crashing, and they just hold on something that is completely junk until when basically the company could fail or go to zero. And so we want to avoid that kind of mistake by being systematic traders, basically. And we do not a huge amount of trading, so this is not like crazy scalping, many trades. There is no over trading. The system are active in the market, but do not trade excessively. The strategies are not trading just for fun, but the entries have been strict. They have strict filters, usually based on volatility, and historically, forward testing or in live trading, they prove to be profitable. That means that usually, if there is volatility, we'll have more trades. But if the range and the volatility is lower, generally the system don't trade as much. Actually, don't trade at all. Sometimes they just don't trade for weeks, or even it can happen in a couple of months if the conditions are not there. Portfolio diversification is another important part. So the main advantage with systematic trading is the automatic diversification of a portfolio by using non-correlated markets, such as crude oil, Dow Jones, natural gas, gold, Nasdaq. The diversification can also be obtained by adding different strategies with different time frames and logic on the same market. So we can have, for example, a system that goes position on crude, counter trend on natural gas, and we can use different time frames, so we can capture intraday moves or swing. A human cannot trade intraday on a discretionary way more than a couple of markets, and for sure he or she cannot trade more than a few hours a day. If you ever try to do day trading for many hours during the day or for many weeks, you know that you cannot last a long time. I saw this too many times, and so in order to avoid this, the computer is far superior than the human mind in the long run. Portfolio diversification is, in my opinion, another holy grail in trading and investing. So risk control and the fact that you can add multiple systems with different logics to manage your portfolio. The systems are developed by using a professional approach, powerful computers, and the most advanced software. One of the biggest benefits of systematic trading is the historical backtesting, and while past performance is not a guarantee of future results, it can be very helpful in evaluating the strength and weakness of a potential strategy. I use sophisticated statistical evaluation models in order to eliminate strategies that do not show robust performances. The markets are not stationary and are more and more efficient than ever, and it's difficult to find an edge that can last for a prolonged period of time. So it's very important to be as systematic as possible, because the market are always changing, and with a lot of volatility, if you trade discretionary, you are going to be frozen sometimes during a market crash, and that could be very, very dangerous. The systems are constantly monitored, and if necessary, a revision of the code will be made available in order to reflect the latest market conditions and improve the results. The personality of the markets are constantly changing, and we need to adapt quickly when trading results are approaching, for example, the maximum historical drawdown or other important statistical parameters that I constantly monitor every day. So markets are changing, and so we need to be on top of that and ready to optimize or rebuild the system if something happens, or move to a new market, because maybe a market just dies and there is no volatility period, and now another market is super active, and then we want to go in that new market with a new system. And so this is an example of the HEPTA portfolio. HEPTA has 7 systems starting in 2015. And again, like I said, if there's one holy grail that I believe in the stock market, on investing or trading, is the diversification, and have like many different systems working at the same time with different logic on different markets. And you can see the results here of the equity graph of the 7 system working since 2015-16 up to the first quarter of 2020. The equity graph just looks great. Now, if you are happy with what you saw, please contact us directly. Thank you very much for attending the webinar. And again, for further information and the latest performance of the systems, please contact us directly at 877-875-0640, or visit the website and on the screen, tradingquantstrategies.com, and someone from my team will be able to answer any question you might have. Have a great day, good trading, good investing, and I'll talk to you later. Thank you.